So, Bill, you spoke about possible turmoil in the financial markets, and I'd like to address that because over the past few days, we've seen some pretty considerable market volatility, having significant gains one day followed by pretty significant losses the next day, and it just seems to be this pattern that we've seen over at least the last few days. What are we to expect in the short and long terms?
Michelle, you are the master of understatement. Considerable volatility. This, you have to go back to the fall of 2008 to find anything comparable. And these kinds of wild, I call them wild gyrations, are indicative of a panic environment, one that's fraught with enormous amounts of emotion. And it's caused because investors really are quite uncertain about what's going on and what's going to happen, but they don't feel good about the prospects.
Right.
And so part of what the market is searching for is to figure out, well, what is it exactly? What are the risks? Is the direction of things? How bad is it going to be? But to begin to probe the answer to that, you have to look back and say, well, what was it that suddenly unhinged the market? Why out of the blue did it go from being pretty steady for a very long period of time and suddenly it just became enormously volatile? And you could say, well, Standard & Poor downgraded the U.S. debt because that was approximately the time period in which the volatility began, but it's much more complicated than that. There really are two sets of things that are going on. They're different, but they're running in parallel and they're having similar impacts on the market. The first has to do with the European debt situation. I've talked about that in letters, we've talked about that in previous videos. And we can talk more about that in a moment here in greater detail. But essentially, the solution that was made for Greece was fine for Greece, but it didn't solve the problem. And indeed, the concerns have switched to a much broader base throughout Europe at this point. And quite frankly, part of the concern that entered into the picture is a slowing of global growth, and a worry that you will have a conjunction of two things that will have a negative outcome. The conjunction would be fiscal austerity, which is intended to get sovereign debt levels down, with slower growth or even recession. And those two things in combination are a toxic mix because they tend to be reinforcing to the downside. Right. All right. Then the other part of this has to do with the United States, and it's sort of a similar kind of problem. It's not a sovereign debt problem, but it is well, I guess it is a sovereign debt problem when you talk about the U.S. fiscal situation and needing to curtail the debt. And also at this same point, the GDP numbers came in much reduced, and it suddenly looks like there's very little growth, and maybe even there's a recession around the corner. And that's what the market's going through, is an enormous amount of uncertainty, but also the news is not positive. So my outlook, more volatility. The emotional bottom has not yet been found. And some days will feel really good because the market will go up 3, 4, 5%, and other days it will go down by a similar amount. Eventually it'll play itself out. How? I think we have further to go on the downside on that basis. How far remains to be seen.